Hello everyone and welcome to the Q4 edition of our Professional Risks Power Panel. It's our final meeting of the year and we'll be delving into topics such as technology-related exposures, ESG and geopolitical uncertainty. And to take us through it all, we welcome back Connor Yeo. He is Advisor Commercial Lines at HK Henderson Insurance. And replacing Candice Petrus, we have Alex Ilkos, who is Client Executive at Purves Redmond Limited. So, gents, let's kick it off. And with the rise of technology-related exposures, such as AI, of course, blockchain, 3D printing, how are you adapting your underwriting and risk assessment practices to address new forms of professional liability, especially, of course, where responsibility may be unclear? Connor, let's start with you.
So it definitely, interesting topic as technology continues to develop over the next little while, and it happens very quickly, as we all know. It absolutely starts to blur that line of responsibility. And so as companies start to integrate these technologies into their companies, it's really going to be important for us, for the industry, I guess, to start to understand not necessarily like what are they using it for, but like how are they integrating into their company. My prediction when it comes to, I have a bit of a prediction when it comes to contractual language. I can definitely see, as those lines are blurring, we'll start to see some contractual language that comes out that helps to is trying to define where that responsibility truly lies. For me, I think it's definitely going to be critical to have some level of like governance or human oversight when it comes to these technologies. As companies use them, we need to have some checks and balances in place that are really going to, kind of protect us a bit. And then from an underwriting perspective, it's going to be interesting to see how this plays out. I can definitely see, underwriters trying to try to understand these technologies at a deeper level so that they can actually, put some sort of pricing in place. It'll be interesting to see what happens. It remains to be seen, but, I have a kind of a question is like, hey, will these pricing structures reflect different types of like maybe AI models you use? Who knows what that's going to look like, but interesting to see how it plays out for sure.
And it's kind of a great point that Connor raised there, Alex, isn't it? In terms of, it's not so much about the software necessarily as it is about how the business is going to use it.
Yeah, definitely agreed. I also really want to reiterate what Connor has said about contractual language. I think that's going to be where the key comes down to this whole component because all the sides are very blurred. So I think there are two separate sides to this story, which we start from like the actual tech side itself and the companies offering those services. I think those type of services were incredibly difficult to place at first, but the market has gotten a lot more comfortable with them now that we have a real proof of concept behind what these products can do. And that leads to where we mentioned the underwriting isn't necessarily right now, as I see it, about the software itself. You don't need to understand what the AI model is doing necessarily. It's more about the efficacy of the model as a whole and the results that they're producing. I also think that this is the new topic, but it really is essentially the same type of exposure that the technology E&O world has always seen. Not that every client's the same. There's always going to be nuance to each individual tech service that's out there, but it is just another version as tech advances, right? So I think we are in a good spot from that perspective, but leading to the other side of the argument and the actual end user of those services, I think that's where the line is a lot more blurred and claims are going to be a little sticky. And that's where we're going to rely on the contractual language. So if you are the tech company and you are offering, let's say, these AI services, making sure that your liability is capped and very clear is going to be of utmost importance in these scenarios. One of the examples I can think of is we recently spoke to like a hospital AI triaging company. So they triage patients based on the type of injuries they had and how the hospital would go about that. Our conversation with them was very quick on insurance, but more about the contractual language on where you stop your liability. So the actual AI tool, they're not the professionals. They're not giving any medical advice. They don't tell you this patient needs to be seen before this patient. There's, if you want to dumb it down, it's giving you a green, a yellow, and a red based on what the hospital has decided is important. So actually outlining where your liability is from that tech perspective, I think is going to be huge. And then when you are the end user, those professional firms, whoever they might be, you then need to understand that contract and where the tech services liability ends. You need to understand that and make sure there's proper due diligence and your professional duty is still there. So use that software, but it's a complementary piece, the technology. A lot of the professional due diligence still lies with you, and you need to be able to verify that, ensure checks are in place, anything related to that to make sure that that kind of risk is cleared up as much as possible. Unfortunately, from a claim side, I still think everyone's going to be brought in originally, which is why premiums might see some hit from that perspective. But yeah, the strong contractual language is gonna help identify who are the real parties involved here.
Well, this is, of course, your debut, Alex, but I'm throwing a couple of big topics at you to get us started. We're going to move from AI, if you don't mind, to the increasing prevalence of class action lawsuits, the rapid growth, of course, of third-party litigation funding in Canada. So just tell us a little bit about the steps that you're taking to manage the potential for high severity claims in E&O or D&O portfolios.
Yeah, I think I looked at this from a very high-level overview, in that from the client perspective, I think we need to understand what those actual risks are, where the market is headed, what areas are growing. We can say that class actions have increased or litigation has increased, but that doesn't mean it's across the board, right? So understanding which area of clients actually has an increased risk is very important for both the client side and the brokering side, right? I also think with that, it helps us benchmark clients. And I think that's one tool that is really important from the broker perspective. Clients rely on you to understand not only what limits to purchase, but what risks they actually have. What type of insurance should we actually buy? And rather than giving an overly cautious approach, just saying buy everything, buy all the limit, they want a real expert opinion, and being able to be knowledgeable in that space and understand where the claims are headed and what is your worst case scenario, what is the realistic scenario or worst case is very important. And then with that same knowledge, the actual brokering in the market is going to be very important. I think diving deeper into what piece of information is important for your clients is huge. So increasing public D&O claims, as an example, is not going to have as big of an impact on your architects and engineers or your private law firms. There might be some impact there, but being able to differentiate where the risk has grown or where the market is headed and which clients that may affect, and you deal with that appropriately, and then the ones that it doesn't affect, and being able to, I guess, approach insurers and clients from that perspective.
Yeah, great thoughts. And Connor, I imagine that you can bring us some perspective from the A&E space.
Yeah, for sure. I mean, it's not necessarily, I won't necessarily talk about class action lawsuits, but third-party litigation is definitely a big area of concern for a lot of, architects and engineering firms. A prime example for, maybe not high severity, but, the big risk from my perspective is when a firm is associated with potentially a larger project, but they have a very limited scope. They have a very minor design involvement in a project. Something goes wrong in that project, and all of a sudden they're getting named for something they had nothing to do with. And it really comes down to if your name is associated with a project, you can definitely be a target of these third-party litigators. And for me, to protect yourselves as a potentially an engineering firm, it's really about doubling down on documentation, and then through that, hopefully you can provide some be very diligent, I guess I should say, in your scope of the job and the clarity of that scope. What are you actually responsible for, and honestly, more importantly, what are you not responsible for? And so that's my big focus when it comes to that. I think at the end of the day, you can be named in a claim, and in the legal environment that we're in Canada, it's extremely easy to get named, and it's very difficult to get your name removed from a claim. So, yeah, I mean that's the big thing. I think at the end of the day, it's documentation.
Let's keep our list of big picture topics going, from AI to class actions to ESG. I'd love to know, Connor, how are you addressing the risks associated with ESG disclosures, particularly, of course, around allegations perhaps of greenwashing or failures in diversity and inclusion initiatives within whether it's D&O policies or management liability policies?
Yeah, so I mean, with these disclosures, the risk isn't that they exist, right? Like, I think we're pretty well aware of that. That obviously a lot of companies make these disclosures. It's really about the companies that are overstating performance of them, and so that might not, originally that might, when you see that on the surface, I guess that might not seem like a big deal, but the risk really is the perception from other parties on those disclosures. And when I say other parties, that might be a regulator, it might be an investor in your company or other employees. They're starting to see these disclosures almost to the same, or view them as the same degree as like a financial statement. And so, the companies that are truly at risk here are the ones that are making these statements, and they might not have the governance that they need to have in place, or potentially data that's truly backing up these claims, or these disclosures, I should say. And really our job, from a broker's perspective, is we need to collaborate with underwriters when it comes to these D&O policies, these placements in place, communicate with them and try to understand, what disclosures are going to be, potentially covered, and then what statements could be, could fall into that exclusionary territory, which we don't want to happen, obviously.
Yeah, no, what's your perspective, Alex? Do you think that the policy language is in a good place?
Yeah, I think the good news from my perspective is, generally speaking, the actual policy language and the definition around wrongful acts in these type of scenarios, I would say it's covered for the most part. Obviously, bearing any specific exclusions like Connor had mentioned, I think our policies currently are in a good place to be able to cover these types of acts, especially your classic overpromise, under-deliver type of risk from a D&O perspective. I think where a lot of our work comes in as brokers is being able to advise the clients on the risk. So a lot of the risk itself comes from your diligence in coming up with those ES or G target, right? But then equally as important is being able to actually track that performance and having proper mechanisms in place. Maybe it's third-party verification in place to actually, track the performance in that area. You don't want to do a set it and forget it, and then that leads to issues down the line. I know from several companies we've seen, the bigger issue is more on that E side of ESG, where you might say, as an example, we plan to be carbon neutral by 2030. And then a couple of years go by, even if we're not at 2030 yet, you can't prove anything. You had no way of tracking your progress or showing that to whoever the stakeholders might be as a whole. So that's where we lead into that misrepresentation and negligence type of claims. The one interesting thing I've seen a bit in the market as well, especially from the larger company perspective, is I think companies are actually leaning away from trying to have that ESG principles being outlined in their company statements. Well, this thought is still there behind all those principles. Connor mentioned it as well. Once you give them a target, that is now what your standard is. And that's how claims might arise. So I think companies are trying to be a bit more vague in the way that they're referencing these principles so that they don't have a standard to hit, especially from an insurance perspective.
They go back to your original point. Policy language may be improved, but I wouldn't say that's necessarily true for all language out there. There is certainly a lot of growing concerns over misinformation, reputational harm. So what changes are you seeing, Alex, in terms of demand for professional liability coverage with this in mind? And how are you responding to those new liability scenarios that are emerging for both professionals and for organizations?
Yeah, when I think of the risk of misinformation, I'm really thinking about the growth in technology. That's exactly where my head goes as AIs come into play, especially, or even just rapid processing or reporting type work. I think that's where a lot of the misinformation has stemmed from. So if you're an actual technology company in that space, or really any company, but looking from the tech side, I think you have to start with what is your risk of misrepresentation? And that's where you kind of dive deep into, what could we actually see come out of this? One of the interesting things I've seen is, let's say, like a BI risk from an AI product. So typically when you think of technology related risk, you don't think of bodily injury, but maybe there's a potential that your AI product causes some sort of bodily injury because you're suggesting something to an end user, whether that be something very severe or not as severe. There still is other potential outcomes, which I think that's where this misrepresentation in work needs to be analyzed of what's the potential risk there. But again, I think my first point, I don't really see these being incredibly different than a typical technology, E&O, professional liability exposure. So I think, being able to group that in, I still think we have a lot of the policies in place. It's about, or the products available in place. It's being able to pick the right ones and structure a program correctly to be able to address all those issues. The end user side is, again, where I think it's a bit more unique, in the emphasis there is more about understanding what each and every one of your clients are doing with that technology. So like, are they using AI? What kind of tools? Maybe it's more than just AI, but what kind of tools are you using? And then do you have the proper checks in place for trusting that information? And remember, the professional duty still relies on you. So trust the information to a certain extent, but make sure you're doing your due diligence. And then lastly, like a brokering perspective, we still need to make sure we're reviewing our policies, in quotes, and the language behind that, so there aren't many gaps. Think of this very similarly to the cyber exposure that came out. Years ago, cyber was not a question for any firms, and now it's a mainstay in a lot of clients' insurance portfolio. So I think we're going down a very similar route. We're going to have to review policies every year to ensure that there isn't a gap in that type of coverage, especially I'm thinking AI. That's really where my mind goes. And right now I think policies are fairly silent to the AI risk, but it is a new development and we have to dive deeper on every client saying, okay, how is AI helping you? What is the potential risk that AI product might be providing? And maybe it is covered right now. Maybe it's not in a couple months. It really depends on where the technology goes, the type of services they do, how they assist companies. And then our insurers looking to exclude some of this language. And that's where we're going to have to maybe dive into new products in the market. But I think as it stands right now, we're at a comfortable place as long as we're on our heels or all the time being able to be prepared for that.
Yeah, and it's such a good point as well, isn't it, Connor, that, when you think about misinformation, your mind automatically goes to AI now.
Yeah, for sure. And I mean, I think we've been in a position over the past few years that, this misinformation term is kind of one that's been really prevalent in the, social environment. And I guess, when it comes to the exposure side, like it's definitely one that, in 5 years ago was probably considered a very fringe exposure when it comes to professional liability. But as AI continues to be, utilized more and more often, I think misinformation is going to become more and more common, and it's because very difficult. It's just myself as an individual, like you're on social media and you see these videos, and it's really hard to determine whether they're real or not. And so I think as the technology improves, we're going to continue to see the blurring of this line between truth and what you want to call truth. I guess apparently that's up for definition these days, and falsities, right? So. I think the social environment definitely contributes to that too. And, I can see, individuals that are part of a large organization maybe share something on social media that contains misinformation, and then that results in that reputational harm to a company. And so again, I think Alex, put a really good point on it. As brokers, it's really our job is to be facilitators. We need to educate our clients in terms of like where there could be coverage if maybe they don't carry a professional liability policy, and this could be an exposure that they're concerned about. So, I really do think that, our job is to, ask the question, find out how much of a risk this is for companies and for our clients, and then, do everything we can to find where that coverage lies and where it might not lie to.
Well, one final question for you, if you don't mind, and then Connor, I'll start with you. There's of course ongoing economic and geopolitical uncertainty at the moment. So, how are you balancing that need for disciplined underwriting, risk transfer, with that increasing demand for certainty and protection from clients that are facing these heightened exposures now?
Yeah, for sure. It's an interesting time. I like you said, there's so much uncertainty. But I kind of looked at this as, we're on this. We've over the past 5 years, we've been in this situation of like the hard market of insurance, and obviously we're all aware of that. But we've just coming out of COVID, we're climbing this mountain of this hard market, and then all of a sudden it kind of flipped like on a heel turn, and the next step we take, it's like a free fall of rating. Um, and despite that, that move into the soft market, especially from a liability perspective, um, there's so much uncertainty when it comes to the economic and the geopolitical environment that we're in. And so, I kind of look at it as we have to be really diligent as brokers, and we're at a bit of a crossroads. Occasionally you kind of get tested out there where it's like, you've been on this path, and now you can kind of decide, are you going to chase this the lowest price possible, or however that looks, or are you going to double down with partners that were with you and like supported you during that hard market. And so you have to make that decision as a broker. And I kind of look at it as, it's our duty to utilize this cycle that we're in and really do our best to get the best possible terms and conditions, and not just chase that price. I think ultimately what I'm trying to do is trying to drive home sustainability for our clients in the uncertainty that we have.
A lot of sense, but it's a tough job to do, isn't it, Alex, to kind of narrow down what that risk is?
Yeah, and that's, I think, our job is we need to really boil down what that uncertainty is and how it would heighten the risk for any one particular client, right? So insurers, generally speaking, I think we all know, they just love to cite uncertainty as a reason for rate increases, but they don't really give you what that is. It's uncertainty where we want to raise premiums, we want to cut coverage, whatever that might be, especially in a harder market. But I think our job is just always 24/7 to challenge that narrative. So is the uncertainty relevant to our particular client or this particular risk? On like a D&O front, as an example, the hot topic right now is more tariff war related, right? But what is the direct risk for every individual client? Maybe it's balance sheet related, it's an insolvency concern, something along those lines. And once we kind of narrow down what that is, we can then address that issue. And then moving to the professional front, the actual professional firms themselves, I think there's a lot to challenge in the term of uncertainty, especially the geopolitical uncertainty. How impactful is a lot of this, like the tariff war, as an example? Should a regional law firm that does family law be as negatively impacted as a North American car part manufacturer, right? Really understanding where that uncertainty is and addressing that individually with each client is super important. Again, I think we need to make sure we dictate the story to our insurers about every risk, right? And on top of that as well, I think from the professional side, you can also look at other risk transfer methods. So you might not be directly hit with a tariff as an engineer providing a service, but you can be indirectly hit. So having strong contracts in place and being a bit more selective with your work can be critical. So if you're a Canadian engineer and you want to potentially take on a contract from a startup contractor based out of New York that might not really have any money or might have an insolvency concern, maybe that's not the work you want to go for at the moment. Again, from the contract language, maybe you need to have something strong in place from a payment term perspective, because what there is just general economic uncertainty, making sure you're going to be able to be paid for your work and you have that airtight language to be able to go after that, I think is a great way of away from the insurance or the risk transfer, just ensuring your contract is strong.
Well, huge thanks to you both for your contributions, and indeed not just today, but to all of our panelists throughout 2025. And indeed, we will be returning in 2026, so watch this space. We'll see you next time, right here on Insurance Business TV.